First, the preface. The intelligent investor is essentially trying to tell us that the market changes, the economic environment changes, and financial instruments keep evolving, but human nature does not. That means a lot of methods for picking stocks or bonds may become outdated, but the principles rooted in human behavior will always remain valid. What really determines investment success is usually not how sophisticated your techniques are, but your mindset and your behavior. The author doesn't teach you how to spot trends or predict the market. Instead, he shows you a way to stay consistently profitable and avoid major losses even in an uncertain future. At the core of this approach is the idea of a margin of safety. In other words, no matter whether the market crashes or inflation spikes, as long as you stick to sound investment principles, you can expect a satisfactory long-term outcome. He also points out that the traditional idea of buy low, sell high may no longer work as cleanly as it used to. After World War, the market entered a long-term upward trend with frequent short-term pullbacks. If you insist on selling at high points, you may never get the chance to buy stocks at a truly cheap price again. But that doesn't mean you should ignore risk and hold everything forever, nor does it mean you should sit in cash. Market crashes and currency devaluation are both real risks, but since no one knows which one will come first, your investment strategy has to be built around uncertainty. The author divides investors into two types. Defensive investors focus on protecting their principal, earning stable returns, and avoiding major mistakes. Enterprising investors want higher returns, so they need to spend time researching and locating undervalued securities, essentially following a value-oriented strategy. Investing is an art. If you follow the basic principles, ordinary people can achieve decent results. But once you try to outperform the average, the risk of failure goes up. So before attempting more aggressive strategies, you need to clearly distinguish between investing and speculating, and be honest about whether you have the analytical skills and psychological resilience to handle it. As long as you stick to a margin of safety and a disciplined approach, investors usually end up with the returns they deserve over the long run. This book is meant to help you learn how to earn solid long-term results in the securities market, even when the future is uncertain. Chapter 1: Investment Methods. Most people lose money in the market. Only real investors don't. The reason is simple: investing isn't about buying randomly. It's about acting only after thorough analysis, making sure your principal is safe and your returns are acceptable. When you have a solid basis for believing you can make money, that's real investing. People who can stick to this principle over the long run usually end up with better results. Your investing approach also has to adjust to the environment. In the past, bonds alone could support someone through retirement. Now inflation has made those returns almost meaningless, so common stocks have become an important choice. The advantage of stocks is that they can rise with inflation and protect your purchasing power, but that also means more risk. You can adjust the ratio between stocks and bonds depending on whether you're defensive or aggressive. The author suggests keeping stocks somewhere between 25 and 75%. If you have enough capital and want to focus on inflation protection and stable returns, you can keep the stock portion lower. If you're aiming for higher returns, then you need to analyze each stock thoroughly before buying. That way, you can build an optimized portfolio to deal with uncertainty in the future. Sticking to the right method requires you to be clear about your mindset and goals. Investors and speculators are not the same. Real investors care about long-term results, not short-term price swings. When the macro environment and company fundamentals haven't changed, short-term volatility does not affect long-term value. Volatility can be a reference, but you can't use it to predict the market. Otherwise, it becomes speculation. For long-term investors, so-called buy low, sell high really means buying good companies at undervalued prices when volatility makes them cheap, holding them, and selling only after the value is fully realized. Market ups and downs aren't caused by inflation itself, but by investors' fear of inflation and their expectations. That's why expectations of rate hikes or cuts immediately move stock prices. Emotion is always reflected in the market. This also means traditional valuation methods alone are no longer reliable. We need to consider future earnings, dividend, and discounting to get closer to real value. Modern markets usually show long-term uptrends with sharp short-term drops. That means things like P/E ratios and dividend yields are now more useful for spotting risk rather than forecasting short-term movements. If you're thinking about hiring an investment advisor, understand that their job isn't to earn you high returns. Their role is to help you avoid mistakes, protect your principal, and achieve reasonable results. Don't blindly believe promises of high returns. There's usually a trap behind them. Choose advisors based on professionalism and match their service to whether you're conservative or aggressive. In actual operation, the author recommends increasing your bond allocation when the market overheats and increasing your stock allocation when the market is depressed. For most people, it's hard to pick high-quality stocks, so diversification is essential. Holding a basket of good companies to earn the average return is perfectly reasonable. What he calls dollar cost averaging, essentially regular fixed amount investing, is a solid method that smooths out timing risks. Remember, active analysis requires more effort, so it naturally yields higher returns. Passive investors tend to earn less. Even for aggressive investors, don't chase high returns by buying low-quality stocks or bonds. The safest path is to start defensively, choose high-quality bonds and reasonably priced good common stocks, then gradually expand. Starting with too much volatility can cause losses, but it also creates psychological pressure, and that pressure itself is a risk that returns may not compensate for. The author also points out that new issues aren't necessarily good, and convertibles aren't necessarily bad. Thinking in the opposite direction often reveals opportunities. Some simple models worked in the past, but once everyone used them, they stopped working. That's why relying solely on technical analysis for buy and sell decisions is usually unreliable. Data also shows that growth stocks don't outperform ordinary stocks on average, yet they come with huge volatility. When growth slows, their prices can collapse. The people who endure that volatility are usually insiders, and they are the ones who profit most from growth stocks. So ordinary investors should be cautious with them. If you want to beat the market long term, don't chase hot growth stocks. Focus on undervalued high-quality large companies and bargain stocks. Those beaten down companies mispriced because of temporary setbacks or misunderstandings are often the most attractive bargains. Always remember, buying a good company is not the same as buying it at a good price. We are after the latter. Chapter 2: How to choose stocks. Let's talk about how ordinary people should pick stocks. First of all, stock selection should follow the same logic professionals use. You mainly look at three things: explain past performance, judge the current price, and estimate future value. Start with simple analysis. Remember, complexity doesn't mean effectiveness. In fact, over-mathematical models often lead to mistakes because the market is full of irrational human factors. And the more you rely on predicting the future, the more likely you are to be wrong. History shows that the most reliable assets are bonds and preferred stocks, because they offer fixed returns and you can estimate their value using long-term data like utilities or railroads, which are very stable industries. Common stocks are much more complex. They rely heavily on future expectations and are easily influenced by market sentiment, which means the more detailed the prediction, the higher the chance of error. To reduce it, regular investors can buy a basket of stocks to diversify and avoid being hurt by wrong forecasts about a single company. When picking common stocks, you can focus on a few key points: whether the industry outlook is good, whether management is reliable, whether the capital structure is healthy, whether the company has a long-term record of paying dividends, and how stable those dividends are. These matter more than interest rates. For defensive investors, stability and safety matter most, not quick profits. Generally, you stick to large companies, such as those in the Dow Jones Industrial Average, and avoid small firms. There are several simple strategies. Or buy all the stocks in the Dow, the simplest and safest. Exclude those with very high peer ratios and buy only the reasonably valued ones. Or pick only the lowest PE stocks to secure steady returns. These methods look simple, but mechanical approaches like this are often more reliable than complicated strategies. For aggressive investors, consistently beating the market is extremely difficult, something even professional analysts can't do. There are two reasons. First, stock prices are already highly efficient because so many smart people are constantly analyzing and pricing them. Second, most price movement is driven by an unpredictable future, which makes the market look almost random. Most methods that try to forecast earnings for the next few years are unreliable because the uncertainty is simply too high. So for an aggressive investor, the most dependable way to succeed is not by predicting the future, but by doing detailed analysis to find undervalued stocks and earn safe returns from them. The author gives several examples to show where undervaluation comes from. Sometimes the whole market is overly pessimistic. Sometimes the business has improved, but the market hasn't recognized it yet. Sometimes the financial statements don't reflect the company's real assets. All of these situations create undervalued opportunities. Companies like Northern Pacific Railway, Utilities, and American Hawaiian Steamship hid large amounts of real assets or cash on their books. With patience, investors earn solid returns from them. In the short term, the market is driven by emotion, so prices swing widely, even though a company's intrinsic value usually doesn't change much. Volatility makes analysis difficult, but it also gives us opportunities. We can buy good stocks when the price gets pushed down. Even great companies fluctuate, like General Motors. The key is not to rush for steady profits, but to wait patiently for a good price. Historical prices can be a reference, but don't use them to predict the future. The environment changes, so their predictive value is limited. The author also found from extensive data that newly issued small company stocks perform the worst. Large mature companies are the most stable, and the market index performs well overall because large high-quality companies have the biggest weights, while low-quality ones barely make an impact. In short, investing shouldn't rely on trends or hot stocks, and it definitely shouldn't rely on past performance. You need to focus on intrinsic value. Company positions change, but intrinsic value is far more reliable. Chapter 3: If you were the owner of the company. As a shareholder, acting as the true owner of a company, what should you do? First, you should actively, rationally, and results-oriented supervise the management team to ensure operational efficiency and maximize returns for outside shareholders. Otherwise, a company's performance will gradually be eaten away whenever management's interests diverge from those of the owners. To keep it simple, let's talk about the relationship between shareholders and management. Legally, shareholders have the highest authority. They can appoint or remove management. But in reality, because ownership is dispersed and there are no effective channels for participation, shareholders can't actually exercise that power. Even shareholders who do have power often fail to act because they lack knowledge, have no motivation, use weak methods, or respond too slowly. As a result, almost any proposal from management gets approved. But management's attitude directly determines shareholder returns, because they almost always act based on their own incentives instead of shareholder benefit. So how do we evaluate management? First, during economic booms, if the company delivers several years of poor returns to shareholders, that's a warning sign. Second, if profits consistently lag the industry average and earnings per share grow slower than peers, that also signals management problems. And when the stock price stays far below the company's book value or trades at a discount compared with the industry for a long period, that's a clear sign of ineffective management. Insider shareholders can manipulate dividends, capital structure, and transactions to protect themselves, and they almost never get hurt by a low stock price. Outside shareholders, on the other hand, can influence policy and simply take the loss when they sell. That's why management tends to sacrifice external shareholders' interests first. Management is naturally stingy about dividends because they always prioritize reinvestment. The outcome is predictable low dividends, depressed stock prices, frustrated minority shareholders, and every complaint gets dismissed with the excuse that management understands the business better. Some high-growth companies even promote the idea that reinvested capital offers higher returns than paying dividends, and the market increasingly accepts low or zero dividends as long as the company can tell a good story. Indeed, there are cases where the market ignores dividends altogether. The market has two logics when it comes to dividends. For income stocks, investors care about dividend yield. For growth stocks, investors care about future expansion and can accept zero dividends. The problem is that most companies are neither true income stocks nor pure growth stocks. If a company isn't a clear growth stock, low dividends usually become the direct cause of a long-term depressed share price. We also need to distinguish between stock dividends and stock splits. A stock split doesn't actually distribute value. True dividends, especially stock dividends, are more favorable because they often incur less tax than cash dividends. The author believes that good companies should adopt a modern, rational dividend policy. The final chapter talks about the margin of safety, which is the core principle of investing. Simply, it means buying assets at a price below their real value. So even if your judgment is off or the market swings, you won't suffer major losses. For example, in bond investing, you choose bonds that yield higher than the market benchmark. In stock investing, you buy companies trading below their intrinsic value. This approach helps you cushion market volatility and reduces your dependence on dividends. You can summarize the key to successful investing in one sentence. Buy assets with real intrinsic value, keep a margin of safety, analyze rationally, and then have the courage to act. That wraps up the content of this book. This channel is dedicated to condensing the knowledge from books so you can learn the most in the shortest amount of time. If you want a full understanding of everything discussed here, please support the official edition.